All right, welcome to another episode of Break Away from the Rat Race. And today I have the pleasure of speaking with Tammy Trenta. Tammy is the founder and CEO of Family Financial. And Tammy empowers families and business owners to keep more of their hard-earned money and wealth, and preserving and growing their wealth. And she's really taking a holistic 360-degree view and approach to wealth and financial management. She's integrating not only financial planning, but also tax and legal guidance to deliver optimal income to her clients. And her goal is really to save you time and money while optimizing your financial goals. Tammy, welcome to the show.
Thank you, Eric.
So Tammy, yeah, we talked a little bit about your family financial practice and all of that. So tell us a little bit about kind of like what you're doing and how you're helping families achieve, grow their wealth, protect their wealth, and also get it done and get it passed through to their descendant without paying too much taxes, I'm assuming.
Sure. Well, I think the best way to describe what I do is a one-stop shop for all things financial. And that idea has developed over the course of being in the financial industry for 27 years, seeing where the gaps were. As a certified financial planner, our job is to be a generalist where you take in everything that someone has. You look at assets, you look at liabilities, you look at income, expenses. And once you have that holistic view, it puts you in a really strong position to deliver advice appropriate and beneficial for clients. When you're having to work with other members of a professional team, oftentimes they just have a different context. So it doesn't mean that their advice is bad or wrong. It just means that maybe they're not exposed to the same information that you are. So as an example, if you have an accountant, your accountant might only be looking at the income reports. That could be your W-2 wage, that could be your dividends, that could be your mortgage interest. They might not ever see your net worth. And so if you ask them a question without the context, you're going to get a different answer. And it's the same thing with legal. So what I like to do is have everyone together looking at the same thing so that the client receives collaborative, consistent advice, and they don't have to go answer shop to other people.
Yeah. Well, this is very good. And this is what I found as well is that, sometimes people, they don't collaborate, they don't see the same, they don't have the same point of view, and they're very niche into their approach. The lawyer is going to look at their little corner, and then the CPA is going to look at their little corner, and then your job, I guess, is to have the broadest perspective and then bring all these people together on the same page so that your clients can actually achieve their goals.
And I really think that they appreciate it. Now, we have in-house advisors that have legal expertise and tax expertise. And so, many clients find that it's just easier to go to the same person for all of those things. You have less mistakes, less things that get overlooked. But that said, I think that the other advisors are the tax or the estate people are appreciative of those calls where you're collaborating, because their business, if you think about it, they have a large number of clients, and if you have an estate plan, it's done once. It's not an ongoing relationship. And even with tax providers, they maybe have 200 or 300 returns to do in a short period of time. It's very hard to take every individual client and help figure out how they're optimizing their tax situations. A lot of it is reactive. They're looking backwards. They're just trying to get the tax return prepared and get it filed on time. So I have trouble sometimes getting a call with the accountant time around tax season because of that lack of time.
Yeah. And you have a very impressive background. I mean, you worked with Wells Fargo Private Client Services in Beverly Hills, financial planning specialist with Merrill Lynch, and then you are also an investment advisor with Charles Schwab. These are the big players in the financial industry. And now you decided to start your own practice.
That's right.
So what made you do that change and start your own practice?
Well, at the time I joined the industry, it was very much a male-dominated industry, and I really wanted to learn. So I had listened to one of your podcasts, Eric, where you talk about growing up in like lower to middle class family and feeling that pain of, scarcity. We're not having that money and feeling like you have to work for every penny that you. And my experience was a little bit different, where we were maybe middle to upper class, but my parents lost everything in college.
Wow.
School. And, I have to say that those experiences really can help shape us. And for me, what it did is it took me off the law school into the course of learning, or into the path of learning about financial literacy. And so then I was able to, when I was hired at Dean Witter, which was in the mid 90s, I thought, even if I don't do this for a living, I will be able to learn this stuff for myself.
Yeah.
And that sort of changed it for me. Now, everyone starts in the financial industry, either in the insurance sector or in one of the major wirehouses. And there are certain licensing requirements that you need to obtain, like the Series 7.
Mhm.
And so what I learned about working for these big banks is, many of them have their own agenda, and their agenda, their accountability is to the shareholder and not to the client.
That's right.
And that always bothered me, that I
Mm.
felt like I had widgets to sell, or I
Yep.
had to sell proprietary investments over something that I thought was better. And I just felt like it was not really an ethical way to advise people. So, the longer you stick in an industry, the more you can see where the gaps are and where people aren't getting the advice that they need. And I got to a point where I've been around long enough. The bosses that I'm reporting to, I feel like I maybe have more life experience than they do. And, I think I'm ready. I'm ready
Mhm.
to do this. And
Yeah.
so that, I think we all get to that point, but in hindsight, I wish I had done it sooner, because I did have all the things. It's mainly the fear that sometimes holds us back, or getting out of our comfort zone.
So those are very good points, definitely. So, and I know, and we've talked about that, about these big boxes, these big like Wells Fargo and Merrill Lynch. I was with Merrill Lynch, or I was a client of Merrill Lynch, and this was always like that. They called themselves like financial advisor and financial planners, but really, they don't have a fiduciary responsibility to you as a client. They are salespeople. They're selling, like you mentioned, widgets for Merrill Lynch. And yes, they understand your needs and stuff like that, the same way a car salesman understand your needs, whether you want a pickup or a sedan. It's kind of the same thing, but they're going to sell you a car. So, and so and I totally understand kind of your motivation. And I think I'm predicting, I shouldn't predict really, but I'm hoping, I would say, that there's going to be more of a shift for these financial planner. I think for the financial planning profession to grow and evolve, I think more of these financial planners need to do the same move that you're doing, which is to be independent and be fiduciaries of your clients, which is I'm assuming this is what you do with Family Financial. You have
Absolutely.
a fiduciary responsibility to your client, and you represent your client. So
Yes, because I never, ever want someone to think that there is any alternative agenda behind the advice we provide.
Exactly. And that's why, I keep telling, if you're not paying your financial advisor, they're not working for you. So that's why, with you, I think, yeah, so with a financial planner like yourself, yeah, you're offering a service and you are independent and you're truly representing the client. I think that's a great service that you're doing, and I hope that more people do the same thing. But I know it's going to increase your competition. But
That's okay. You know what? I am industry focused, and if I can make the industry better in one way, then I feel good about that. I think, the independent space is such a tiny, tiny segment of the overall wealth that is held in the financial institutions. And there is a large percentage of both people, those big box wirehouses, and moving to the independent advisor. I think 10 years from now, we will have more fiduciaries. And what's surprising about it is the fiduciary standard is like, it is the standard in most other countries. This is the one place where it's okay to be delivering financial advice with an ulterior agenda, where you're receiving a commission for the product that you sell.
Mm-hmm. Yeah. So a lot of your clients are they're affluent families, they're high net worth individual. And, there's a lot of strategies, obviously, when you have the bigger your wallet, the more strategies you have, the more things you can do with your money and all of that. But, most people are not in that situation. Any kind of strategies that some of the middle class, hardworking Americans can use to kind of advance their finances and their family wealth?
That's a great question. So I have a pyramid I've put together, and it might be described. The very bottom pyramid, we call them the spenders. And those are those families that live paycheck to paycheck. They don't have the ability to save. So, it's very much a scarcity mindset. And in the next level up, you've got savers. And that might be someone like my mother, who's a school teacher, who understood the value of saving, but didn't really understand anything about finance. Yeah. And beyond that, you get to the investor. And the investor is someone who's accumulated some money, they've got some financial expertise, but they still have to multiple people to help them navigate, right? Their lives have become more complex. And then you get to the highest stage, which is the wealth creator. And those are oftentimes the business owners or perhaps the real estate investors that have really created their own wealth. 99% of the population is in the spender and the saver category. And so what I would say to that is, you don't have to stay where you are. You have a choice. You have a choice to jump levels. But in order to jump levels, you have to, number one, be your own financial advocate. A spender may not have any money to hire an advisor, and therefore they're not going to get the best advice because they can't afford it. You have savers that can afford an advisor, but that segment of the population is a breeding ground for commission-based advisors because, think about it. If someone has $100,000 and they go into a major bank and that bank rep says, oh, you've got this money, why don't you talk to our investment person? And 10 minutes later, they're in an annuity that the advisor got paid 8%, right? That's $8,000. For us, since we work on a percentage, for us to make the same amount of money, we would need $800,000. And so that the advice is authentic when you're targeting people who are not financially savvy and you're working with brokers. So the most important thing, if you have accumulated some money, you do have the ability to save, is go on to broker check. Broker check, you can look up an advisor's name, and if it says B, then you know they're a broker. If it says IA, you know they're an independent advisor. And if it says B and IA, they're still a broker. They just also have an advisory business.
Yeah. Okay. Wow, this is very good. So this is broker check, right? Brokercheck.com.
Yes, check.
Okay.
I
Well,
think
this is very good. Yeah. Yeah. I mean, this is, if you're a spender, this is living paycheck to paycheck. So, you know, it takes a lot of effort to go from spenders to savers. You either have to get a side gig or really look very closely at how you spend your money and really start saving, you know, really cut down on things that you may not need. Once you're in the saver category and getting into more the investor category, it's a little bit easier. And once you save enough money, I mean, I talk to a lot of people that are in the savers category and they're just starting to invest. They're just transitioning, buying a single family rental, for example, and they save like $30,000 or $40,000, and now they buy their first investment properties.
Yes.
So I talk to a lot of people like that. I talk to also a lot of people that are spenders and move to savers. And I'm telling them it takes a lot of effort to go from spenders to savers. You have to really cut down. You don't watch TV, cut the cable, you know, and eat at home, sacrifice, and then find a side gig, you know.
Agreed. Especially now with the emergence of the gig economy, it's not uncommon to see individuals that have day jobs that are doing side hustle. Great way to create some extra money to save, you know, if you're not able to do that. And, you know, I think at the bottom where it really starts to have an impact is, imagine if the entire educational system, imagine if every high school required a course in financial literacy. I think that would change the world. We would have fewer spenders. We would have more savers. Because, you know, I think you mentioned in a former podcast, everyone had defined benefit pension plans. They weren't needing to learn about it themselves, or companies did it for them. And now in this day and age, you really have to advocate for yourself. Work with a fiduciary, make sure the advice is objective. And it's not easy to do because so many advisors will call themselves a fiduciary, even though they're not. And the term financial advisor can mean insurance salesperson. It can mean broker. It can mean so many different things. So you really have to do your homework.
Yeah. So I'm glad you mentioned financial literacy. I'm also a big proponent of that, and this is why, you know, why I'm doing these YouTube channel, and I post on TikTok and all of that, and because I want people to be aware of, you know, of that, what they need to do, kind of like how to look at numbers, how to look at investment, how to look at their budget, and all of that, and you know, and how you can do some decisions that are contrary to what mainstream or Wall Street want them to do. And so I think that's important. And having that financial literacy, I mean, my cynical self is thinking that they did it on purpose. They want people to be ignorant, and so that they can continue to buy and consume and all of that, while the top 1% or 5% are actually they have financial literacy, and then they can enjoy that. That's my cynical self. But what does it take to make it happen? What does it take to have people? The number one thing is to learn about financial literacy. What does it take to change the education system to show this, to teach people this? Yeah,
and some of it is, I mean, I think Governor DeSantis, regardless of your political affiliation, he's mandating it in high schools. And I think that's an important step. I certainly was not financially literate, even though I grew up in the real estate business. When my family lost everything, I was scarred by that. And the idea of investing in real estate at that time was scary. And, you know, now I have a method of how to do it. I know the analytics. And so even though I'm advising on money, I will always look and analyze a piece of real estate for a client and have those discussions with them. Because as you know, sometimes it can be an emotional purchase. It's like, oh, my uncle money in real estate, and that's my path. And so I kind of like to look at every option as an opportunity.
So one of the things that you mentioned too is you mentioned defined benefit, right? My parents, my father was like, we're living paycheck to paycheck, definitely a spender. There was no savings, anything that happened, but he still managed to retire. It was, he had the pension plan, and he's retired, and he doesn't have to worry about anything.
Yes.
All these things are gone now. There's none of these corporate pension plan. And you mentioned that the importance of everybody becoming their own financial advocate, really focusing on their finances. And the 401k savings, it may not be sufficient for you to retire on. If you have a 401k. If you don't have a 401k or any kind of retirement saving, then it's another discussion. But again, becoming your own financial advocate, and then knowing that this is extremely important and you need to focus on that as soon as possible.
I did a spreadsheet that showed if you could just do the employer match and defer a little bit out of your paycheck and save 10% of what you earn every year, you could be a millionaire by the time you're 40. Mm-hmm. And so it's just that mindset of setting a goal and figuring out what you need to do to achieve that goal.
Yeah, exactly. And people don't realize that, but I mean, this is why it's so important to do it as early as possible. That you have a lot more options, and it's a lot less painful than if you wait very long time and then you have to decide kind of how you're going to make it, how you're going to save $2 million in the next 6 months because you're retiring soon. It's a lot easier to save $2 million when you begin, you're 20 years old and you have 40 years to save that.
Yes. Well, time tends to accelerate results. And so if you're doing all the right things and you're on track, you will find at one point that the income that you have coming off of your investment portfolio looks like a salary. That was an eye opener for me, because my parents were not great savers. That can happen is if you delay and delay, every 5 years you delay, you have to double the amount that you're saving. Mm-hmm. And so, if we have an excess of time versus money, these running out of money, barely making it, having financial success, you're as close as ever going to be today to be able to jump those curves. And so the more you wait, the more difficult it is something really big needs to happen for you to be able to jump lines to get to the place of success that you want to be.
Yeah, I totally agree. The other thing too that about financial planners in general is especially the one I'm talking, not necessarily the ones that have the independent advisor. I'm talking more about the one that work in the big box and how they sell a product. Like Merrill Lynch, for example, they would sell, the things that the services and the products that they offered. And so they don't sell real estate. They don't make any money for real estate. So they're never going to tell you that, hey, you should have like 25% of your portfolio or 40% of your portfolio in rental real estate. Mm-hmm. So how about at Family Financial? I know your family was in real estate. Are you including real estate rentals as an important component of your portfolio?
And every client is different, mm-hmm. as you know, but most of my clients own real estate and they own investment real estate, and I help them. I have one client who owns 9 properties, and his investment account was small at the time, and now he's got millions of dollars because of the planning that we. So I think that there is value in both. Mm-hmm. I think opportunity is everything, right? There could be a terrible piece of real estate but if you're hooked on that, I have to buy real estate, might not make a well-informed financial decision. It's the same thing with investing in the stock market. There's good stocks and bad stocks. So I look at, and let's that financial outcome. And if it's not stocks and it's real estate, the first person to tell someone this is a great opportunity. You should go for it. Another thing I will tell you that, it does help the rich get richer, but wealthy people have access to very low borrowing rates. And so when you have accumulated a taxable investment account, you can borrow against that investment account to fund real estate investors. So, if your goal is no money down, you're using other people's money to create these income streams. And as you know, with real estate, the depreciation component can become very valuable. Yeah. So it is part of almost all of my clients' investment strategies, and it folds into what the estate planning strategies will be. I have countless examples of how we have designed things to help people just keep more of what they earn and minimize their tax liability.
Yeah, exactly. Yeah, I mean, you can make bad investment in any asset class, so that's for sure. What about crypto? What's your opinion on crypto as part of family wealth planning?
So cryptocurrency is, I think, still in a very speculative form. I do think that more companies are adopting crypto. I think it will become an economy driver at some point. The US government will adopt cryptocurrency. So, if I have a client that would like to invest in it, a simple rule of thumb is let's call it gambling, because it's speculative. You could lose all your money. I don't have any history of predictability on it, very limited. And so only invest what you expect to lose, and make sure that whatever amount of money it is, it does not compromise your financial independence goal. And that's how I look at it. So for some, that might be 10 or 20% of their portfolio because they're devoid of anything speculative. But yeah, I think that there's definitely, cryptocurrency is here to stay. It's just still in its speculative stages right now.
Yeah, I totally agree. And I like also how you put it too, is that as long you can invest in this, as long as it doesn't compromise your goals. So correct. I think this is very good. And I mean, you look even at some of the people that have a lot of money, like the Elon Musk and all of that. I mean, they invested 1% of their wealth on that. So just to give you an idea.
Exactly. Right. So, and it in dollar amount, it might seem like billions. Yeah. But that doesn't mean if that doesn't work out, they're still a billionaire.
Exactly. And if it works out, then, oh my God, we're going to have to, they're trillionaires.
Hopefully they give more to the causes they're passionate about.
Yeah. Or buy more social media.
Right.
So Tammy, this was a great conversation. So thank you very much for spending this time with me. If people want to reach out to you, what's the best place for them to reach out to you?
So I have a website for my business that is familyfinancial.biz.
Okay.
People can also reach out to me on LinkedIn, Tammy Trenta. You can do a search and it's a public page.
Very good. Well, thank you, Tammy. It was a pleasure speaking with you.
Thank you.
All right. Take care.
Have a great day, Eric. Take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.